Many traders ignore volume, and although volume is a simple concept, it's difficult to analyze it correctly due to inherent challenges in the markets. These challenges make it impossible to read true volume with the standard volume indicators, and although most traders are familiar with price and time oscillators, very few use volume oscillators. Volume oscillators are uniquely different than price oscillators. Instead of signaling overbought or oversold price action, volume oscillators provide far more valuable information about what is going on with the stock price before the price actually moves. This gives traders a leading indicator that shows the direction of price, breakout moves, momentum runs, and bottoms or tops ahead of price action. But there's a small problem. Most volume oscillators you probably use, like OBV or money flow, don't always have leading qualities. If I have to guess, you probably use average volume indicators, where the average of volume is calculated over a given number of past bars to see if volume is increasing or decreasing over time. And it's okay to look at volume this way, but you'll be missing the most vital volume information. This isn't the best approach to analyze volume, and let me show you why is that. Volume has inherent distortions, which will lead to a faulty analysis by many traders. For example, in the stock market and other markets to a lesser degree, the opening of the day has a multitude of orders that had built up overnight and all get processed at once. This large influx of trade volume creates a major distortion to what is actually happening in the market. Another distortion is created in the middle of the day, when the majority of market makers go to lunch and market activity slows down. A third distortion happens at the end of the day, when traders try to adjust their orders before the market closes. They may want to be flat overnight, or they may want to get into a trade, but this influx of orders at the end of the day is another distortion to the volume. Another challenge to using a volume average indicator is that every instrument has considerably different levels of volume. For example, compare a stock with 40 million shares per day versus a stock with 10,000 shares per day. This vast difference makes it difficult to read volume from one symbol to another symbol. Additionally, if you change from one time frame to another, there will be huge volume differences. The volume on a 1-minute time frame is much different than the volume on a 60-minute time frame or a daily chart. The key to getting past these challenges is to use the time segmented volume. Time segmented volume is the way to get consistent volume data and eliminate all the volume distortions that we discussed before. So, time segmented volume is a volume oscillator and is considered one of the best volume oscillators ever written. Its main advantage is the fact that it reveals large lot versus small lot activity on the market. This indicator is similar to the on-balance volume, or the OBV, because it measures the amount of money flowing in or out of a particular stock. But, with a big advantage, time segmented volume is an oscillator that compares various time segments of both price and volume. So TSV indicator measures the amount of money flowing in or out of a particular stock. The baseline represents the zero line. It segments a stock's price and volume according to specific time intervals. The price and volume data is then compared to uncover periods of accumulation, meaning buying, and distribution, meaning selling. Time segmented volume is a leading indicator because its movement is based on both the stock's price and volume. Here's the key to why the time segmented volume works. Let's start with the volume on a 15-minute chart, and for example, look at the 10-15 bar. Now, take the average of only the 10-15 bars over the prior month and compare the average to the current 10-15 bar. The difference will give a true reading on whether today's 10-15 bar is higher or lower in comparison to the exact same time bars over the past month. Now, when you read the 10-15 bar, you read a price bar against the volume bar. For example, let's say that price action shows a larger than normal bar, maybe 2 times normal. Let's say price started out close to the bottom of the bar with no wick, and it runs up and closes close to the top of the bar. This means a strong bullish bar, but if you look down and you see less than average volume, then you should be cautious about the price movement. In contrast, if you see a 200% volume, you'll know that the increased volume was the reason for the extra large price bar. The key to understanding volume is reading price action and volume action on the same exact bars using time-segmented volume to give you the true volume information you need, and reading the chart to see if price and volume are in harmony or if they are divergent. Time-segmented volume can confirm the move, make you suspect of the move, or can tell you if it is the end of the move and if a likely change in direction is coming. In any case, using time-segmented volume will eliminate volume distortions and increase your trading edge. Now let's discuss how to read the time-segmented volume oscillator. When TSV crosses up through the zero line, it signals positive accumulation or buying pressure. This action is considered bullish. Conversely, when TSV crosses below the zero line, it indicates distribution or selling pressure, which typically precedes a move down in price. An important aspect to look for when reading the TSV is a contradiction of trends between price and TSV. Look for positive or negative divergences between price and TSV in order to determine potential tops and bottoms. Several consecutive divergences increase the reliability factor in trying to pinpoint price reversals. For instance, if a price is making successively higher highs while TSV is making successively lower highs, this would constitute a series of negative divergences. This would be a leading indication of a possible top. In this case, the TSV indicator exposes the distribution pattern of the big market players quietly selling the stock even while smaller lot buyers push price up to the final high before the correction. If the price is making successively lower lows while TSV is making successively higher lows, this would constitute a series of positive divergences. This would be a leading indication of a possible bottom. In this case, the TSV reveals the accumulation pattern of the big market players quietly buying the stock even while smaller lot sellers push price down to the final low before the rally up. This is what I call volume divergence trading, which is more powerful than regular divergence trading. You see, the big problem with most technical traders is that they rely too heavily on price and time indicators and don't evaluate volume indicators sufficiently. In the current marketplace, however, using only price and time-based indicators isn't enough for gaining consistency in the long run. Nowadays, with institutions using many variables of specialized orders that control price, volume is even more critical to use. Price no longer is the most important indicator. A combination of price, volume, and time indicators offer the most reliable, consistent, and leading indication of how price is likely to behave in the near term for short-term trades. So here are other examples of positive and negative divergence trades using the time-segmented volume oscillator. Using an exponential moving average with the TSV provides an easy-to-read crossover signal prior to a breakout move. This is a huge advantage for technical traders, especially during choppy sideways markets. Being able to see the breakout crossover signal on the TSV will allow you to get in ahead of the breakout. When the moving average is above the center line, this is a sign of accumulation, and below the center line, a sign of distribution. So for an upside breakout, for example, Pay extra attention to the TSV oscillator. If you see a period of accumulation, meaning the moving average above center line, and you see a new high in the time segmented volume at an important area of resistance, that's a high probability signal that the breakout could be valid, and a future upside move could follow, like in this example. Keep in mind that as you increase the value of the moving average, the result is a smoothing effect. However, there's a trade-off. As you increase the length of the moving average, the indicator becomes less sensitive to daily fluctuations, and as a result, the indicator will have a greater tendency to lag price. So if you tried some of the conventional ways of day trading breakouts and they aren't working for you, the time segmented volume will serve you better. Here are other examples of breakout trades using the TSV oscillator. As always, if you learned something new and found value, leave us a like to show support, and don't forget to subscribe and hit the bell icon to get notified when we release new videos. Until next time.